Okay, so the midterm itself, we're going to, not the midterm, sorry, we're going to be talking about the final right now. So the final for this class, it's going to be 60 questions. Each question is going to be equally weighted, and you have 3 hours to do the exam. So each question you have about 3 minutes to work on it. I'm going to go through the questions right now. We're going to be focusing mainly on the last few chapters that we've covered, everything after the midterm, and then the fundamentals. I'm going to make sure I want you leaving here knowing basic accounting. Like the accounting 101 class, that's a real goal here. So I'm going to really hammer home a lot of the fundamentals as well. So I'm going to be asking questions like classification questions on the balance sheet. You need to know which ones are assets, which ones are liabilities, and which ones are equity. That should be easy at this point because that's one of the first few chapters. But I want you to know, like, if we in assets, if I ask, say, hey, is accounts payable and assets? You say, no, that's a liability, right? So some of these things, assets, what we know, like cash, accounts receivable, inventory, liabilities, right? We have our accounts payable. We have our notes payable, salaries payable, whatever. We have our equity. So I'm going to expect you need to know your accounting 101 balance sheet, what's in them, and what's long-term versus short-term. Okay. We also need to know like why we have adjusting entries. So what are adjusting entries? What's the accrual method, and what's their purpose? And the main purpose of that, so adjusting entries are the part of the accrual method of accounting. And why do we have the accrual method of accounting? We've talked about this on numerous occasions, but it all goes back to those principles we talked on day one, right? The matching principle, the historical cost principle. We want to match revenues to the expenses that generated the revenues, right? So that's the whole reason we have adjusting journal entries is because of accrual-based accounting. So we follow those GAAP principles in order for companies to be able to apply the theoretical frameworks consistently so we can compare them, right? All of those theories. Understand all of the different financial statements. So financial statements and the flow of them. So balance sheet, income statement, statement of cash flows, and retained earnings, or what we call shareholders' equity statement. How are these created, right? We do the income statement first. The income statement creates the balance sheet. The income statement creates the statement of retained earnings, which creates the balance sheet, which then we use to create the statement of cash flows, which we learned in the last class, right? The indirect method is one of the ways we can create it. So know those flows. And know that we've talked about this a few times, like balance sheet is at a point in time, right? Income statement is over time. It measures the full year, but balance sheet is measured on a day in the year. Cash flow is measured over time, right? The statement of retained earnings or the shareholders' equity shows it over time as well. It shows the activity. Balance sheet doesn't show the activity. It shows it at a static point in time. So understand that as well. Understand all the assumptions we've talked about. One of the most important assumptions is the business entity assumption, right? What does that mean? It means that owners and businesses are separate from each other. That was one of the first things we talked about. It's one of the large hurdles that a lot of accounting students struggle with, right? Your money, even if you own a business, your personal money is different than the business's money. You have to put your personal money into the business's bank account, right? We're going to be talking about a lot of allocations and trend analysis, right? We talked about that in the last class, but I need you to be able to determine growth rates. So everything we talked about last time, like horizontal analysis, vertical analysis, ratios, all of those things you need to be able to prepare. So if I ask you if our sales started at 290,000 and went up to 400,000, what was the growth over those two periods compared to year one? Just so you know too, I'll be putting true and false in here too. I sprinkled in some true and false so it's not so overwhelming, so you have some extra time. The return, let's see. We talked about earnings per share, right? Which also is a measure of return on common stockholders' equity, right? How much we earn for every share, and so we know that that is actually a significant driver of valuation for businesses, right? And how you measure a company's success. So that's important. I need you to be able to calculate working capital. Every ratio we've talked about, I need you to have in your repertoire, right? So we went over the DuPont analysis and the ratio analysis, which is all of those, like the working capital, acid test, short-term asset, or all our liquidity analysis, all our solvency analyses, our profitability analyses. We need to know all of those, and you have the slides for them. So we talked about acid test. Make sure you know that. And I'll make sure you know all your turnover ratios and what they mean, and that the trick there is that they're by the average amount of total assets, right? The denominator is the average amount. So just don't choose one or the other. You have to divide them by 2. Let's see. Know the difference of the terms. So we have like liquidity and efficiency. We have solvency. We have profitability. We have market prospects. We have creditworthiness. Like liquidity is and efficiency are the abilities for a business to meet their short-term obligations. Solvency is the long-term obligations. Profitability is how much money or how much cash flow or income the company can generate from its business. Market prospects are the valuation of the company, like the price earnings ratio. And creditworthiness is how it compares from lending institutions. We've talked about like the bond ratings. I'm going to ask you to calculate the price earnings ratio. That's an important ratio we talk because it drives valuations of how we can choose if stocks are discounted against each other. I'm going to ask you to calculate net cash provided by operating activities. So cash flow, statement of cash flow. Operating activities. Using just the indirect method. I'm not going to have you do the direct method. We talked about profitability, the ability to get financial rewards sufficient to attract or retain financing. I'm going to make sure you need to know your classification, right? That's one main thing I talked about with statement of cash flows is I'm mainly going to be testing on classification. So I try to test you on, hey, if we sell machinery, is there any amount of, where would that go? Is that investing activities? Is that financing activities? Is that operating activities? Right. So make sure you know where like selling machinery would go. Selling machinery isn't an operating activity, right? It's an we're selling a long-term asset. So long-term assets are a part of our investing activities. If I am doing an equity, that's in our financing, right? If I'm issuing equity or taking on a long-term liability, right? Just know those buckets. And then also remember, there are some adjustments. Like if we are having the interest expense related to a financing activity, that might be classified as an operating activity, right? So know those one-offs. Or if we have a gain or loss, the gain or loss is an operating activity, but the selling of the asset itself is an investing activity. I might ask you just to calculate ending balance of cash. So I could give you like beginning cash, here's our investing, financing, and operating activities, what's our ending cash? And then I could ask you to fill in any of the blanks too. I'll ask you what the primary purpose of the statement of cash flows. And right, that's to change from the accrual method back to the cash method and discuss all major inflows and outflows of cash. I'll ask you to classify, to calculate retained earnings, including income and dividends. So retained earnings. We talked about treasury stock, right? And so we will ask, where does treasury stock go on the statement of cash flows? Right? That's part of the classifying. That's one of those trick things, right? Because we're buying it, but that treasury stock goes into financing activities, right? Because we're buying it from ourselves. And what else is included in the financing section of the statement of cash flows, right? Any equity transactions, right? And so treasury stock is an equity transaction, not we do the treasury stock as a reduction of equity. It's not necessarily an asset, right? That's why it's on the financing activity. Interest revenue isn't a financing activity. Interest revenue would be a operating activity because it's related to directly to income. Sale of equipment would be an investing activity. Interest expense is an operating activity. So know those classifications. We went over them in detail. I'm going to be testing just like I promised, I'll be testing classification heavily. And I shared a lot of videos with you on that, so hopefully those will be helpful. And so the tricks where I see with cash flows that everyone seems to struggle with is just don't get tricked on interest revenue, interest expense, gains or losses, right? Those should go in operating. And then the underlying financial instrument, the notes or the assets themselves, the value of the sale is our investing or operating, our investing activities. The gain or loss or the interest is the operating. So if you think about it from a journal entry perspective, if it hits income, it goes into operating, right? I'll ask you to classify more operating activities. Statement of cash flows is going to be a good 10, 15 questions. Talk about, let's see the section. I'm skipping over some of these. It's all classification questions. Let's see. And determining retained earnings. Using beginning, retained, RE, income, or loss, and dividends. We talk about price earnings. It's going to be tested. Corporation, yeah. We talked about corporations and some like corporate structures, right? Briefly. And we said you're going to learn more in your business law class, but the important piece that I want you to take away is corporations are separate from their owners, right? They're actually their own legal person. We talked about that and how that gives us liability protection. I'm going to ask you to calculate paid-in capital because we talked about equity, paid-in capital, excess of par. So we talked about stated stock, par value stock, and whatnot. I'm going to be focusing on the par value stock. And the journal, so just know your journal entries in general. Journal entries for equity. That includes, right, common stock, par, stated value, paid in capital, in excess. And so you just remember that we take the stated value, that is going to be our true value. We'll debit cash for the total cash amount, credit the common stock for the par value amount, and then they'll be paid in capital in excess of that value. I want you to know the journal entries for dividends. That includes cash dividends And it includes the 3 dates we talked about: the date of declaration, the date of recording, and the date of issuance. And so remember, the date of declaration, that's when we put the liability on our balance sheet. We debit the retained earnings, credit dividends payable. The date of recording, we don't do anything. And the date of issuance is the date that we then reverse the liability out and pay the dividend. You need to know your treasury stock journal entries. Remember that treasury stocks are a reduction to equity generally, right? What's not an asset. And it's its own account. Right? I want you to know some of the options we talked about just for preferred shareholders. So like we talked about dividend preference for preferred stock. It means that dividends for preferred shareholders are issued before common shareholders, right? We talked about dividend preference. We talked about some of those other interesting rights, the legal rights that people can have. So make sure you understand those. Make sure you're able to calculate the dividend. Dividend paid and the dividend yield. We talked about those calculations, right? You take the number of shares multiplied by the dividend issued, and it's the shares outstanding, right? We don't take the shares authorized, we do it by the shares outstanding. Remember, we talked about stock dividends, cash dividends, property dividends, and stock splits, right? So know the different types of dividends. And their journal entries. Dividends, stock dividends, property dividends, and then stock splits. Remember that stock splits don't have journal entries. Right? The rest do have journal entries. We talk about bonds, right? So next piece, long-term liabilities. We're going to go into that. Long-term liabilities, I'm going to ask you to know the difference between a premium and a discount. I'm not going to have you do any net present value calculations. Just know if a bond is $1,000 and it's selling at $1,100, it's at a premium of $100, right? Know some of the pros and cons of debt financing versus equity financing. What's a good thing about debt financing is we don't take on more owners, so it doesn't dilute our earnings per share, right? The owners get to keep it. There's also tax advantages to having debt, where our interest expense can be written off against the tax. But there's disadvantages as well. We have a fixed amount we have to pay towards the debt, right? That for equity, we generally don't have those fixed amounts. It's just the dividend. So the way I like to think about it is, if I'm going to start a business, let's say I am starting a business that's going to make $100,000 a year. There's 2 ways I can start. I need $100,000 to start it. I can either pay for it myself if I have the money. Let's say I don't have the money. And there's 2 things I can do. I can bring on a partner to give me some money, or I can go to a bank. If I go to the bank, then I'm going to have to borrow the $100,000 and pay interest. And what if my business doesn't pan out? Then I'm going to lose out, right? I'm going to have to wind up going bankrupt. If I have a partner, and I lose out, if we both lose out, then he loses out on some of his money, I lose out on some of my money, but we're okay. Like, at the end of the day, we don't owe money to a bank. The partner shares some of that risk of loss with me. But then let's say what if the business is successful and I make $100,000 a year? Now I have a partner. Now I have to share that $100,000. We each get $50,000. Well, if I paid off the bank, then every year after I paid off the bank, I'd keep the 100,000 for myself, right? So this is the pros and cons of equity and debt financing. It's nice to have someone share the risk of loss with you, but if your business is doing well, you wind up having to give a lot of your capital, your future earnings to someone else. So it's the bond doesn't change ownership control. I'd say personally, some of my worst business decisions I've made in my career were bringing on partners when I was younger. I should have just done businesses myself, or brought on partners at a lower rate. It's very expensive. Make sure you know your bond journal entries. So if you issue bond at a premium, is that a credit or is that a debit? How much would it be? If I tell you, if I give you, say that it's issued at a $6,000 premium, would it be a credit or a debit? Right. For bonds, premiums are credits and debits are discounts. I need you to be able to calculate the semi-annual interest payments on bonds. Don't get caught up. I might ask you to calculate the total annual or the semi-annual. So be careful. A lot of people, when they met with me for the midterm, a lot of it's attention to detail. So like you have 3 hours, use the 3 hours. If you go back after you're done with the test, if you're done, then you have an hour left, go back and reread it because that's where you're gonna get tricked. There's some of these tricks, right? So spend the extra time because there's both, right? There's both. I could give you an annual amount in the test question or a semi-annual amount, and it might throw you off. We'll also know the J's for retiring bonds, right? And know that when we retire the bonds, you're going to have the opposite journal entries for the premium and discounts, right? To issuance a bond at a premium, you would credit the premium. To retire the bond that has a premium, you would debit the premium. So kind of know those journal entries. Make sure you got that. Know your notes payable journal entries. Something I'm going to be doing in this test is I'm going to throw you extra information. All right, so make sure you're prepared for that and focus on what the question's asking you. If I ask you to determine the journal entry for the issuance of a notes payable that has a 15% interest rate and is going to be paying quarterly at $30,000 a year, you don't need to know the interest rate or anything. You just need to do the debit to cash, credit to notes payable, right? I'm going to give you extra information to see if you understand where to focus and you can use your critical thinking skills. Remember, when we're doing interest for notes payables or bonds, you're going to be using the market rate on the date of issuance, right? So it should be the stated rate. It'll say like, what is the company either issued 5% bonds or the stated bond is 5%. But if the future market rate, so if it says the market rate is 7%, which would you use for your bond? You're going to use the stated rate, right? The 5%, the 5%, not the 7% if the market rate goes up, right? The market rate would be used for your net present value calculations. So just remember to use stated or interest calculation and then market rate or net present value determination. I'm not going to ask you to calculate net present value, but you will need to know that in your advanced finance classes. So I'm glad that we at least introduced you to the topic. Then I'm going to really start digging in the whole last leg of the exam. I have 15 questions that are fundamentals. Like I need you to know these to leave the class successfully. So I'm going to ask you about adjusting journal entries. Right. AJEs. What I mean by adjusting journal entries, I'm talking about, hey, on November 1st, we issued some debt with an interest rate. What's the adjusting journal entry on December 31st for the 60 days that we owe interest but haven't paid it yet, right? We're talking about all those different types of accruals and deferrals. I'm going to need you to understand those and be able to calculate them. So that includes, right, I want you to know interest calculations, depreciation calculations, I'll keep it simple for the depreciation, like straight line using salvage value. AR, accounts receivable and accounts payable, and what happens when you collect it. I need the journal entries for all that. We're also going to just talk about some other high level, like internal controls. I just need you to know the definition of internal controls and like what the purpose of it is. Like internal controls are there in order to prevent and not to prevent, but to lower the risk of loss for a company, right? It doesn't insure against the company's profits. It doesn't eliminate the need for audit. It doesn't require the use of non-computerized systems. It isn't something that's going to, it's not a solve-all, right? It just lowers the risk of loss. We talked about internal controls of like having things like bank reconciliations, having things like having our, having someone who counts the cash be the different person than the bookkeeper so that someone can't steal the cash. Making sure that we have electronic systems like credit card systems in order to collect cash rather than using cash. Having a lockbox. These internal controls, it can't prevent theft. There's these things we talked about, the fraud triangle. Remember the fraud triangle with rationalization? That we really can't get around some of these things. We can't get around the fact that people want to rationalize stealing money, but what we can do is try to make it more difficult for them. And that the only way to do that is through a system of internal controls, what will lower the company's risk of loss. Inventory. I just want to make sure, go back, revisit it, make sure you understand for FIFO perpetual method. FIFO, LIFO. Let's revisit it. And the journal, I want you to know the journal entry for selling inventory. The key there is the journal entry for selling inventory is two-pronged, right? You have sales and cost of sales. Make sure you know all your accounts receivable journal entries. We talked about accounts payable journal entries. What's the difference between accounts receivable, accounts payable, and notes payable, right? Accounts receivable is always from customer payments. It's from customers, it's not from the bank. Know the definitions of those. Know the different definitions of all the accounts. Like what's a common stock, right? What's dividends? What is a revenue? What is an expense? What is a liability? I'm not going to go over them again. We've talked about it so much. What is a dividend? Your deferred revenue calculations. Revenue. And what is deferred revenue, right? Is deferred revenue when a company has earned and received cash? No. Deferred revenue is a liability where the customer pays in advance, right? We get cash in advance for services that we have not yet performed because we have an obligation to perform those services, or generally refund the cash. We will perform those services, right? If we don't perform those services, we would be in breach. Know your prepaid accounts. What they are, the definition and journal entries. Talked about financial statements. I'm going to have a few questions just to make sure you get it. I want you to be able to calculate net income independently. So if I give you a fact set, like here's revenue, here's a set of journal entries for starting a business. Company started a business, they got equipment, they had this expense, they paid this salaries, they received this much revenue. I want you to be able to calculate net income from that fact set. We should be able to do that by now. And I want you to be, if I give you a fact set, if I give you 9 or 10 journal entries, I want you to also be able to calculate the assets, liabilities, and equity from that fact set. So 8 to 10 JEs. Some of these will be longer questions, so make sure you budget your time. If you've got a true-false question, like go through that quickly, mark your answer quickly. But then some of these more quantitative ones, make sure you spend some more time with, like the FIFO, LIFO inventory, or the journal entries, going through the journal entries, calculating revenue. Make sure you know your debits and credits. We've talked about them a lot, but I'm going to ask you some ones just to make sure you get the fundamentals. Like for all these journal entries, you need to know which one's your debit and credit. Like if it's an expense, we have a debit. If it's revenue, it's a credit, right? You're going to need to know that for all the answers, or most of the answers. That's it. That's the final. All right, so we can go up here. You can see it seems like a lot, but it's just the chapters we've covered and then fundamentals, right? Chapters we cover, we're going to go over adjusting journal entries. We're going over the financial statement flow, the business entity assumptions, the analyses we talked about, like ratio analyses. We're going to go over the statement of cash flows chapter. Make sure you can do it. The class, it's going to be focused on classification. Then we're going to be focused on equity entries. So treasury stock, just a little treasury stock, but mainly focused on, can you do the paid in capital entries? Can you do the dividend entries? And then focus on the different types of dividend entries. Then we're going to be talking about long-term liabilities, right? Everything we did after assets pretty much in this class, right? We tested up to assets, and then we went to liabilities and equity for this last chapter, these last chapters. So long-term liabilities, know about your bonds, what a premium and discount is, how they're calculated, how the interest payments are calculated, and how they're determined for accrual-based accounting. And then we're going to just to fundamentals, right? The fundamentals being a little bit of everything, but really focusing on debits, credits. Do you understand how it would flow into the balance sheet? Do you understand how it would flow to the statement of equity and retained earnings? And then the basics like calculating net income. So that's it. 60 questions in 3 hours. I'll stop recording this. I'll share that with the class after. Stop recording.